Thanks for joining, everybody. Can you hear me? Good. All right. So I'm going to start off and talk about the data center industry. The data center landscape is undergoing significant transformation, and today we're joined by leading experts to explore these trends. So let's get started. Over the last year, we've seen rising borrowing costs, increasing inflation, power shortages, land scarcity, and growing regulatory hurdles, along with a lot of community resistance, NIMBYism. So yet the data center industry continues experiencing a boom. In fact, the strong demand from AI continues to attract these new investors to the space, and now real estate developers such as Goodman, Prologis, Hines, and Lerner, to name a few, are all actively stepping into the sector. But is this market overvalued, and are we in the final stages of consolidation? With the emergence of edge computing and the race to build hyperscale data centers, how is this industry evolving? Do opportunities still exist? To answer these questions, our panel of experts will share their insights on this evolving market. So let's get started. I'm going to start with Ellen at the very far right, and then work our way down.
Good afternoon, everyone. My name is Ellen Hall. I am the head of direct real estate for Fidelity Investments. For those of you who are unfamiliar with Fidelity, it's a privately held multinational financial services company that is based in Boston. It's one of the largest asset managers in the world, with about $5 trillion of assets under management. Fidelity is the 100% owner of Colt Telecom and Colt Data Center Services, who most of you probably have heard of. Colt DCS has about 20 sites across Europe and Asia.
Thank you, John.
Yeah. Hi, good afternoon, everybody. John Wilson from SMBC. We are a global investment bank. We're one of the top three Japanese banks, but we cover the data center space globally. We provide primarily two things. We provide construction loan financing for hyperscale operators, and also part of the time we're more involved in is on the site acquisition financing as well. So this is pre-contract, where we are assisting operators to acquire land. So delighted to be here. Thank you, Mark.
Thank you, John. David?
Good afternoon, everyone. I'm David Ellis. I work in the Energy Location and Strategy Group at Google. So we're responsible for delivering data center capacity to the company. So that's everything from site selection and power for our own self-build through to the acquisition of capacity through third-party vendors.
John?
Hi everyone, I'm John Plavnik. I'm a partner at GIP on the credit team. GIP is a global infrastructure investor. We own a number of digital infrastructure businesses on the private equity side, and on the credit, out of the credit side, we finance these businesses globally.
Alexander Boyard. I work at Brookfield Asset Management, so another asset manager. We focus solely on tangible assets, and data centers are one of our largest conviction teams. I've been leading the European strategy for 3 years now, and upon acquiring Data4, I also have been seconded into the business, so happy to share thoughts both as an investor and operator, or novice operator.
Chester.
You share a unique position in that regard, I'd say. From my perspective, I'm Chester Reed. I'm the Chief Financial Officer of Yonder Group. We're a data center developer and operator. We're deployed globally. We're one of the few truly global data center developers and operators. We have operations and data centers in APAC, and obviously in EMEA and North America as well. So I'm happy to share my thoughts with you all today.
And I'm Miles Liu with Newmark. I've been praising data centers for over 20 years. I founded the very first data center specialty practice group when I was in middle school. just joking. But in the last 12 months, we've been involved in 800 valuations across 6 continents, and that equates to over $85 billion US. Okay? So let's first begin by talking about what's happening in capital markets today. So this week, the Bank of England released data showing UK's inflation rate has dropped to its lowest level in 3 years. John, can you start with you and shed some light on how this unexpected drop is influencing borrowing costs and interest rates, especially as it relates to data centers?
Ooh, goodness. Let me have a go at this. So, I think this sector depends massively on favorably priced debt and equity, and arguably the growth of the sector, I think, has been underpinned by an abundance of cheap debt, and also different investors coming into the space as well, different investors with different IRR thresholds, which have allowed assets to trade. So, to answer your question, I think interest rates and inflation, they matter a lot. And as you say, inflation looks like it is coming down in the UK. Whether or not we'll get to 2%, one more read before the election, we'll wait and see. I suspect one or two people will probably hope it does get near that sort of number. I think to a certain extent the markets have priced in the fact that rates should come down during the second half of this year into next year. I think when I looked this morning, 5-year Euribor swap was around about 2.7, and I think UK SONIA 5 years is probably around about just shy of 4%. So the markets are definitely thinking that rates do need to soften. And this really matters because typically and historically operators have funded data center projects through a mixture of both equity and debt. Clearly, the debt is where you want to get to because that's typically based off hyperscale contracts and the hyperscale credit ratings, and equity is being used up until that point. It becomes relevant because there's a drag on equity and what you can do to reduce that cost. And what we're seeing at the moment, particularly on site acquisition work, is that land values are going up. So therefore, the impact on IRRs is quite profound. And so kind of what we're doing about it is looking at ways that we have funded site acquisitions as opposed to using equity, and that provides both an IRR benefit as well as liquidity to the shareholders. So
Okay.
They do matter, and they do matter a lot. And I think you'll see other types of financing and alternative strategies coming into play as we go through the rest of this year and into next year.
Let me ask you, Chester. I mean, John's saying that interest rates are going to be cut, but I heard that there's speculation that the anticipated interest rate over the summer may now be postponed because of the inflation drop, right? Considering the data center's heavy reliance on capital investments for growth, how do you foresee this potential delay impacting the industry's expansion plans and financial
The cuts in interest rates, is it?
if it's postponed?
Yeah, I mean, obviously to John's point, it's a mixture of debt and equity, so obviously we finance data center investments. From our perspective, I think a drop in interest rates or a delay in the drop of interest rates would be important for a couple of different reasons. If you think about the way the current financing spectrum of the marketplace occurs, there's a lot of new demand in the marketplace. And there's also a lot of new banks that are coming into finance the demand for data center investments globally. And from a debt perspective, even though the interest rates have increased, the biggest effect it has had to a large degree is sort of on the increase in cap rates that we've seen as well. So that's obviously had a big effect from a platform perspective on how people view overall platform values from a global data center perspective. But if we think about the delay in interest rate cuts, I don't think it'll have a very meaningful effect on growth. There's so much demand and so much excess or additional banks coming into the space that it's creating competition from a large degree with respect to margins. So even though the base rates might be higher, I think especially if you're lending at sort of 80% LTC rates, you have a much broader group of banks globally who are coming into the sector. And that drives competition, therefore drives margins down. Now, if you're going above an 80% LTC, there's probably only maybe a handful of banks that are comfortable with that sort of risk profile.
Mm-hmm.
But I think the fact that we have this additional demand in the global marketplace, I think that acts as a counteracting point to the fact that interest rates will not decrease in the short term.
Okay. Well, you mentioned platforms, and Brookfield has an extensive portfolio of data center investments. I want to ask Alexander, how is Brookfield approaching the financing of new developments in the current economic landscape? With factors like rising interest rates, supply chain shortages, what type of innovative financing or strategies are you exploring to ensure continued growth?
I think that today we are still, especially if I think you need to look at different places of the world differently. I think North America is a place which is a couple of years ahead of the curve compared to Europe, and so obviously what you've seen there, I think down the line will come here. I think if we focus specifically on Europe, we're still at the point where you can go to a club of banks, including SMBC, where you can have a platform type of financing, which is very interesting and very flexible and works. Now, obviously, as everybody's been mentioning this morning with AI, we are seeing a waterfall, snowball, or avalanche coming of demand, and that will need to be financed. And I think at Brookfield, we really see the solution for that in two ways. So one is innovation, the other one is partnerships. And you will need those partnerships to get preferential access to capital when people need gigawatts to be financed. If we look at the innovation, then we will see, or we anticipate to see, the opening up of new debt classes, including securitizations, as well as bond issuance, as well as a combination of private debt and private institutional investors that coming directly into the capital stack and so on.
Yeah, you mentioned partnerships. Ellen, Fidelity's partnered with Mitsui. Given your extensive experience across the various asset classes, what key factors have contributed to the growing interest from institutional investors for you and your partners?
Yeah, good question. We've heard a lot of it today. I think it's a couple of things. One is certainly the demand tailwinds, which, including AI, Internet of Things, etc. It's in the news and investors want to be part of it. I think it's also, the steady, really utility-like cash flows and the risk-adjusted yields of these investments. I think the customers today that occupy these buildings have excellent credit, which certainly helps. So, I think the combination of stability, the growth potential, just the strategic importance of the asset class in our society today and going forward has really made it attractive to various investors.
Can you compare the returns for traditional asset classes to data centers?
Yeah, I think it's all relative. I think it depends on where you're investing, whether that is development or core. But I think if you're looking at development, again, we just spoke about interest rates. Developments are still pricing 150 to 200 basis points over sort of stabilized cap rates. Cap rates are tied to interest rates, and so I think if you look across the various asset classes, data centers are no different. Chester made the point there is a lot of capital pouring into data center. I think there's also some allocation issues going on. Some of these big investors who used to invest in offices aren't doing that anymore, and so there's money pouring into the sector, which I think is giving it a bit of an advantage in terms of its return profile. But I think again, it's all sort of relative.
Well,
And to
I think it's a good segue for me to ask John. Let me ask you, given your deep experience at GIP and infrastructure investments, what are your observations regarding the evolving pricing segmentation within the data center market? From a real estate, project finance, securitization, and private credit markets. How are they reflecting on pricing trends?
Yeah, I think that's the interesting development in the US, where it has advanced really, really quickly. I think data centers specifically, digital infrastructure in general, but data centers specifically have been very fast in using every technology in financial markets very quickly. So they went into the securitization market, and within 3-4 years, now we have billions of dollars outstanding. They've been able to navigate rating agencies, they've been able to navigate a segment of institutional buyers who do securitizations who may not do other classes. And so those guys need to compare what does a securitization look like in the US from data centers versus consumer finance or any other asset class that you may have. And so you have that pricing that is driven by the supply and demand of securitization paper at a given rating. And then you have the project finance, which is the majority still of financing. And that seems to be anchored in the US at the SOFR plus 200, plus minus whatnot. To me, what's interesting is it all arbitrage perfectly? No, it's not. But you start with a greenfield project finance at SOFR plus 200, And then once you fully mature and you put that in a securitization vehicle, you're issuing paper again at SOFR plus 200. And so, the market in the US is pretty interesting. And then you're going to have what you mentioned, Alex, which is, you're going to have the bonds on term loans and fully stabilized assets and so on. I think that it's hard to look for whether it's arbitraged or not. I think the main defining feature is there's a lot of capital out there, and I think it will be a matter of continuing to develop those technologies to supply what the market needs. My final comment is, on interest rates having gone up, the debt sizing tends to suffer, so a lot of times you can still get kind of the rates that you needed, but then not at the same LTCs and whatnot. How do you supplement that? You bring in more equity, you bring more subordinated debt.
Would you say that the private credit market is more favorable than traditional bank loans?
No, I don't think so. I think we can partner. Speaking now, we have a private credit. I think we partner very well with banks. I think that banks have a tremendous amount of capital that they need to continue to deploy into the sector. But we do service different type of not only on the fund. People always like to talk about price. I mean, yes. But there's also other things. I mean, private credit can be longer in maturities. Specialized infrastructure funds can actually go through construction, but they don't need to be taken out immediately post. That refinancing risk when rates go up, when you see that you yourself, let's talk about all the take private digital businesses, and then you need to refi that. That's a risk as a CFO. So I think there's complementary.
And maybe just to pick in on one point you mentioned on the arbitrage, I think that between, let's call it 2010 and 2020 roughly, like we've seen 10 stable years, but the industry wasn't stable yet. And now that the industry is stabilizing, the financing markets just haven't been open because of COVID and Ukraine and Israel and all the crises that we've seen. So I think actually it will become very interesting once the global economy kind of stabilizes, if it will. Then I think you'll see the real arbitrage coming because all the markets will be open.
Yeah. Well, as a result over the last 12 months, because of that, we've seen a recycling trend, and that's where, given the high cost of capital, established data center operators like Digital Realty are selling surplus assets, and strategic properties to fund their expansion of other projects. So I want to ask, how is this property sales strategy being received by investors? Do any of you have those conversations?
I think that like you were speaking earlier about new people coming into the industry. Mm-hmm. I think that we have those a lot with our investors. They want to get, whenever you speak to them, they'll mention two words: decarbonization and digitalization. And for a pension fund or insurance company to get access to these assets, either they can buy debt, but even though the high interest rate, it's not very interesting to them. So what a better way is there than to buy an asset with a 10 or 15 year lease with a AA credit? They won't find many better opportunities. So we are constantly educating our investors on the advantages of the asset class, and every conversation we have, they're asking more information. How can we do this? So I think it's going to be huge.
Don't worry, David. I got a bunch of questions for you.
I'm sure you do.
Give me 10 minutes. So this dovetails right in when we talk about partnerships, and I want to come back to you. In 2021, you guys partnered with Mitsui through a joint venture and accelerated Colt Data Center's hyperscale strategy in Japan. So how important is the operator from an investor's perspective?
Obviously, I would say this, but I would say very important. Then you can ask David, but I think...
So would I. I'd be biased though.
Exactly. I think it's important to the investor because it's important to the occupier. So, I think an operator who's been with the facility from the very beginning, who has built the facility, knows it well, knows the customer well, means a lot. I also think for an investor, having an operator who helps them underwrite it in terms of maintenance capex going forward is critical. So I would say very important.
I'd agree with that.
Good.
And a lot of people ask, what is the impact of AI to the sector? We're beginning to see a lot more new players come into the space, like industrial REITs. We mentioned earlier, Goodman, and Prologis, right? Goodman's dedicating like 80 billion. Prologis announced they're dedicating 20 billion. So, with that in mind, how will the entry of these new industrial real estate developers impact the competitive landscape? This should make you happy, right, David?
Very much so. I think, at least from our perspective, there is such a demand that we have to meet. And one of our main challenges is time. Delivery of capacity when we need it.
Sure.
So we need capacity at different hold points, and those different hold points are more suitable to different types of
You have undeveloped. Developed.
So whether it's powered land, powered shell, or a full co-location, there are different vendors for different options there.
Okay. And do you anticipate changes in pricing because of this new competition in terms of availability?
I would like to think so,
Okay.
and hope so.
Okay.
Sorry.
We can also.
So you think
Can
there's
I
going to be?
ask you a question?
So
Is
is
it going to be, with some of the new entrants like Prologis, for example, like, is there going to be, higher price points associated with, retrofitting logistics sheds instead of building something from scratch? Are they going to be at a competitive disadvantage to the traditional operators who just build as they see fit and don't have a portfolio of assets that they're retrofitting? So I'm just saying there could be higher price points associated with that. And I think that could be, we'll see, but if they're certainly looking at retrofitting existing assets, right, there just will be larger capex, the cost per megawatt's going to be higher. And the only way they can maintain the yield is by, reflecting that in the rate that's charged. So I think there's some, I think there are some challenges there for me.
Yeah. So what challenges do you see when delivering infrastructure to support AI?
Shall I take that one?
Yeah.
So I think for us, from a Google perspective, we are having to deliver capacity for multiple products. So it's everything from cloud is still there. Don't forget it. It's still growing significantly. We've still got our consumer-based products as well. Search and YouTube, which are not insignificant. And then this new shiny thing called ML AI has come along that we need to satisfy. And there's a lot of talk about AI ML and whether it's real and whether it's not. I think it's fair to say, from our perspective, it's very real. There is a significant amount of capacity that we need to deliver. You've seen that in some of the announcements. Public announcements we've made recently in the UK, Belgium, Netherlands, Finland. There will be more as we self-develop to meet that capacity demand. But one of the main challenges is time. If you think about the large language models, the better the bigger the model, the better the model. And to get a bigger model, you need more capacity. So we're trying to meet that, to build bigger models. But it takes a long time to build, self-develop a large multi-100 gigawatt site.
Are there any data scientists in the room? Want to raise your hand? Phil? Let me ask you a question. What are the different stages of AI?
You're asking me?
Yeah. Go shoot from such a research.
Do you want my seat up here?
I see you're not paying attention, so.
So stages of AI?
Yeah.
So,
Inference, production, machine learning.
Okay, yeah, I mean,
Yeah.
quick analytic would be, I feel like right now very similar to kind of like hyperscale build out. I think they're from the core hyperscale to build zone regions and edge.
But in terms of requirements, like what are the different stages in terms of years? Like we have 1 or 2 years of machine learning, and then you go into inference, and then what's after inference?
Could be 3 to 6 months.
I made the point yesterday that it was like a decade-long process to build up hyperscale and then start to decentralize.
Mhm.
I would say most of the things we're seeing now would be basically this time frame between building up the training models and then actually increasing for the edge scenario, which is
Yeah.
basically a parallel dynamic. Faster.
Yeah.
If you put that in my head, say yes, I say half the time. That's what the cycle is ready for. But my guess is probably as good as all 6 days. Probably all come to a good answer. But I would say using previous parallels and accelerate.
I've spoken to a lot of people, and they say they can't see beyond, 3 or 5 years. No one knows what the future is. So my question is like, why are hyperscalers now, as a result of AI, signing longer lease terms?
I think certainly one thing that we're seeing, Miles, is that I can think of.
Let me preface too. If we got all these shortages right now,
Yeah.
and there's constraints in the market, with a lot of that supply coming in 5 or 6 years, are we going to have a bubble?
So we'll just say
I'm
no.
not gonna,
For the sake of the industry, we'll say no, right?
I can jump in that grenade question. So I think it goes to the core of how capital markets, financial markets globally are seeing hyperscalers, right? And I think it really checks a lot of the boxes if you're in finance or talk about bankability, project finance. If you were to, I think it's been refined to the point of you have really good counterparties with very strong, contractually solid, long-term contracts and so on. You have relatively well-known infrastructure, real asset-based, and so on. Very limited maintenance and whatnot. So from a financing perspective, investment-grade counterparties, of course, and so on. So. Is there a bubble, or can there be oversupply? My sense, what will probably happen is things are on the edges. So as long as the credit quality of the parties on whose shoulders the whole thing is being built, which are 4 or 5 corporates that are very, very strong, and I think they'll continue to be so, then generally speaking, I would say no, you're okay, unless you expect those contracts to be breached. So I would probably say that's going to be okay. Now, the problem is a lot of people are not focusing on the risks. And if you cannot see risks, then that should be alarming, and you should be rethinking why you are not able to see risks, right? So companies building land banks aggressively on spec, thinking that they're going to use those land banks to build and get contracts and so on, could be a red flag. Not a lot of people are talking about that. Accelerating procurement and buying equipment or buying different things in advance and not thinking about and thinking that then they can. So there's a number of things around the edges. Do I think it's a bubble? No, I don't think so. And the other point is, why are they signing 15-year contracts? Because I think David said correctly is, it's not only AI. I mean, from a debt standpoint, to me, maybe controversial, is AI to me is an equity story right now. I'm a debt guy. I'm a gray guy. I mean, I'm not seeing any significant material portion of revenue or EBITDA coming from any of these companies in relation to AI. It's cloud for now. I don't know what the percentage you guys would say, but.
The one thing I would say is that we've seen recently, obviously over the last 12 months, but very recently, the new type of deployments that are required on a very large scale, liquid cooling straight to chip, which are for completely for AI deployments. And even in terms of the internal structuring and the design that it takes in order to do that, like these are things that are coming to the fore. Originally, sort of 18 months ago, it was all a bit of bluff and bluster. Everyone was talking about AI. You practically saw the demand with cloud migration. It was up and to the right. AI was a new vertical. We did feel the demand, but we didn't actually see that in terms of different design deployments that were catering specifically for AI. But we are seeing that now amongst hyperscalers, which is something significant because ultimately it's going to lead to what you just said, which is revenue down the line. Right? But you're not seeing it in their P&Ls now, but they're certainly getting prepared for that.
What are the key considerations? Maybe this is a question for you, David, but I know you're focused on energy. But what are the key considerations for building data centers that can efficiently handle both traditional and AI workloads?
So, I think the difference with AI, ML, and you have to break ML, AI down into different elements. So you can't just stick it all in one bucket, because a large language model that's running for 3 months and it goes down will just run for 3 months and whatever it's gone down. But on the back of that, you may have differing AI applications running on the back of it. So I think as a piece of guidance and advice is not only to investors but operators is try not to put all your eggs in one basket and future-proof your assets for multiple products. So yes, a large language model might only need N, but what happens when that large language model's done? What can that asset be then be used for thereafter?
Yeah, AI has been known to be like the inflection point for our industry, where it's like a big gold rush. So, because it's a big gold rush, we're beginning to see disruptors come into this space. I don't know if you guys have been following, but Bitcoin mining companies are rebranding their platforms. You see companies like Applied Digital, Northern Data. They're diversifying the revenue streams by trying to attract data or AI workloads. So, do you see this impacting the data center landscape? If something came across your desk, okay, do you think you're going to begin seeing significant investments in M&A activity for this AIs in tertiary markets?
Is that kind of feedback to a power scarcity play, right? So whether it's the AI disruptors or whether it's just the kind of migration of the entire demand profile of hyperscalers globally. Being AZ, focused, and you can weigh in on this, to be, power focused to a large degree. If you have sufficient power in tertiary locations, and you have that runway, so 100 megawatts to 300 megawatts, 500 megawatts of IT load. See a lot of people talking about the gigawatt data centers. Not quite there yet, but getting there. I think that is obviously a preference for a lot of the hyperscalers. So if you're talking about, where is the demand profile? It's a power-led strategy. Power is the scarcest resource. And even the operators and investors and the hyperscalers themselves are coming to a kind of a unified mindset in that regard. If you can find the power, that's where you'll go. You deploy new AZ there, right?
It's been easy so far because we've always found power in primary markets, but now we're pushing out into secondary and tertiary markets. So would you feel comfortable, John, lending on an asset that's in the middle of nowhere?
I think there are two bits to this. I think.
Yeah, what's your
It depends, doesn't it?
What's your alternative use?
Well, exactly. So on the site acquisition thesis that we get up to, we will look at obviously data center land valuation, and then try to correspond that to what's the alternative use case, and that to previous point where you see logistics sort of pivot into this space. That's quite a well-trodden path. I think some of the issues we've got is that whilst we're looking at locations in tier 1, tier 2, and we spend more time actually now on tier 2 markets, they're not necessarily in the established metros for those tier 2 markets, so they're a little bit out, and people are following the power. So key for us is trying to be able to really understand what the demand for power data center land is, either in the established market, it's quite easy to do, but when you're going slightly more out onto the extremes, because frankly some of these alternative land values don't look particularly great because there's no infrastructure around it to support logistics. You can be looking at a cabbage patch, which isn't a great alternative land use. So, but I think John made a good point as well. At the moment, the thesis behind what these deals will look like when they hit the banker's desk will be, hopefully there'll still be a very sound financial sponsor there. There'll be a great operator who knows what they're doing, and there'll be a long-term contract from Google or others as well. So I think the fundamentals will still be there, and I think the fundamentals are still there, then they should attract senior debt.
Yeah. Okay. Yeah, I mean, data centers get a bad rap on energy usage, but I mean, it's not just our industry that's competing for it. And you see semiconductor facilities, EV facilities, they're all fighting for power, right? And even Elon Musk said, last month at the Bosch Connected World Conference that, because of the chip shortages behind us, but it's, these AIs and EVs are expanding so fast that the world's going to face supply crunches in electricity and transformers, next year. So for the industry, there's a lot of uncertainty, especially in our industry, being able to address the increasing demand for data center space. So with that in mind, what do you think that's going to happen? What do you think is going to happen to power rates? If the next couple of years, is just basic supply demand, right? Do you think power rates are going to go up as a result? And is that going to be a key factor in terms of decision making for site selection?
I think just one viewpoint is I think everyone needs to be very thoughtful about where they are locating, particularly multi-100 megawatt sites, and rather than targeting traditional locations to the previous question. Look at where there is abundance of power, where there is abundance of renewable green power, whereby locating a data center there can actually help in some cases by trimming off excesses in renewable incoming power, for example. So I think as an industry, we just have to be a little bit more thoughtful about what we do. We need to partner better with TSOs and other infrastructure providers, so that together we can, I wouldn't necessarily say solve the problem, but not make the problem worse.
That's a good point. So let me ask all the investment people here, right? What role is sustainability playing in your investment decisions? What are some of the key criteria that is used by investors and metrics today?
I mean, I can start, and then others can chime in. But I would say it's very important. I think, and it's for a couple of reasons. One, it's the right thing to think about. I think partnership is key. I also think, just from our perspective, being a fiduciary for investors, that's what they want. And it's not just the investors who are giving us the capital; it's the occupiers who are occupying the space. So it's important to everyone around, and when you sit between that, it's important to you as well.
Yeah, it's been said that increased ESG practices have led to concerns about greenwashing. Regulators, especially in the EU, are now more worried about companies engaging in greenwashing or making exaggerated climate-friendly claims to attract investors. Do you think, greenwashing is a big problem for ESG?
At least from our corporate perspective, the green agenda is very, very high up in our corporate, challenge. We're committed to 24/7 green energy in every location that we operate. That is challenging to match, every hour of consumption with the capacity. But it's not only that. I think, for investors, it's investing in, particularly in these large sites, investing in the communities that we are locating, particularly if they are rural, because it can have a significant impact on the communities that we're going into. So
So do you think that integration, you're saying all the right things, but do you think that integration is a pathway or a challenge to value creation?
Integration of what?
ESG.
No. It's obviously going to be very valuable for everybody. From our perspective, it's a core focus. We have an obligation to get to net zero by 2030, and that's what we're trying to achieve as an organisation. And sometimes, a little bit like what John said earlier on about, sometimes there's obviously the core piece, PPAs and everything else that you're trying to achieve, but there's also things around the margins that you can do with respect to your organisation. It's taking that extra step to ensure that you're taking a green path as opposed to the easy path. And that may have cost consequences associated with saying, but I think everybody's happy enough to both pay for that in order to make sure that the data centers that are built for customers of for the hyperscaler type, which are obviously extremely important to us.
I think if you take a step back and you look at the last 10 years, then this question has been coming for a very long time, and I think history has proven that if you're ambitious day one and you do more than you need to, well then in year 2 that will be the norm. And you'll be able to do it in a way that makes sense for every stakeholder involved. And from that point of view, by investing, taking your time and just doing it because it makes sense, you'll benefit down the line. And I think that's what you see if you look at, construction practices, if you look at power procurement practices, if you look at the way that you treat your people, over time, this is happening, so you better anticipate.
Yeah.
I think, David, you got a good view, of all the players in the field, right? With constraints on land and power, what are players doing to get ahead of the curve?
I wouldn't say they're ahead of the curve. I would say they're running to keep up with the curve right now.
Do you see trends from microgrids or other on-site power solutions, so-called bring your own power?
I think it's still nascent. That is definitely a path that needs to be taken. With particularly on very large scale sites, we can all foresee SMBs as a necessary solution down the line. Can it come quickly enough for what we need? Probably not, but it will be, I'm sure, utilised, and there's a lot of cooperation between organisations to make that happen.
Mm-hmm.
There is more to be done. There is definitely more to be done.
So let me ask, anybody can answer this, but what risks should investors consider when investing in data centers? Like, what keeps you up at night? What are you watching that gives you pause or confidence?
Well, just from, we're not an investor, obviously, we're an operator, but I mean, from an operator's perspective, it's simply dropping a data center. I mean, that can be cataclysmic for a brand, right? So we're exceptionally sensitive to that. We spend a lot of money on our operations. We have very big operations teams. We have the controls that we have in respect of operating data centers we would say they're better than our peers, but I'm sure Alex would argue with me on that one. But I think we both agree. Like, I think that's one of the very important points, and you just can't drop a data center. That would keep me up at night.
For me, from an investor perspective, what I hear and what I believe is all around the fact that it's such a new asset class, so there's really no historical data for investors to base their investment decisions on, which they're uncomfortable with. Coupled with the fact that we're talking about really big check sizes. These aren't small investments, and so that just adds to the fear. And then this whole issue around obsolescence risks. I think those of us in the room can convince ourselves why that's probably not a risk, including the occupiers signing long-term leases. But if you're new to the industry and you think about technology changing, it's scary. So there's so much education going on. The reverse to all of that is what I said before. There's so much confidence in the demand side of the tailwinds, and I think investors are getting there. But those three things, I think, are tough.
For all the talk about growth and AI, I mean, what are the key risks that's not being discussed right now in data centers?
I think that even though it's a new industry that's growing very quickly, the way that business is being done is the same as it was done 20, 25 years ago. And that way of doing business has so many disadvantages that it's hard for me to understand that that it's so hard to actually change this. And for example, we can talk about the way that we do business with the clients. Like, the Colo model has been around 25 years. And the difference was that then it was a 2-year contract and for 100 kilowatt. Now we're speaking about 15, 20-year contracts for multiple 100 megawatts. And there are different ways to operate, but it's very difficult to keep doing it or to change things. And that is actually something that I find bizarre and keeps me awake.
I think also from a debt perspective, we've heard today about the billions that are going to be required to support the sector going forward as well. So the capital markets has to keep up.
Mm-hmm.
No one's saying they won't, but clearly huge amounts of capital have been deployed already and will continue.
What about the
to be so
takeout,
as
John?
well.
I think everyone talks about that, the takeout, of these facilities. Loads of construction facilities, was what, 30 billion in the US alone. I think last year was, what's the ABS market? It's about 10 billion now. I mean, there's a disconnect there. What's your views on that?
Yeah, the 2022, the securitization market stalled a little bit. And I believe 2022 was a year in which most of the take privates, the M&A that had been announced in 2021 had to close in 2022. That was very challenging because just getting it done, valuations were falling, rates were coming up, geopolitics and whatnot, and there was a question of, okay, how do you take out all of these bridge loans, and then you have the construction loans, but then also the bridge loans on the take private, and the securitization market came back, everything tightened now again, but yes, I think you have refinancing risk on the AI side. I agree. I mean, technology is changing really quickly. I mean, the density of each one of these racks, what that will mean in terms of liquid cooling, I think we don't know really how quickly things are going to start to evolve, and how on the finance side we will need to be at par with that. So I agree with the 3 to 5 year visibility kind of period, and I think we need to focus again on the risks. I mean, I think that it's a great story and we need to continue there, but we need to be all conscious about some of these risks.
Just the lack of diversity in the customer base as well. I mean, they're all incredible companies, obviously, incredible.
Too many high credit.
Yeah, no, but I mean, there's not that many, there's not that many, it's a handful, really, and they constitute sort of 90% of the market.
How would you underwrite like an AI company if you were look at one? If you want diversity? Would you?
I'll jump into that one. Yeah, I mean, at the end of the day, there's not a lot of pure play AI. So, I mean, the easy answer to that is, I don't think people are underwriting AI companies. They're underwriting massive companies doing AI as one of their many different portfolios. So for now, I think it's not that hard. I mean, in general. Now, if eventually, what concerns me with AI, going back to your point about risks, is one of the key things, and I heard someone very smart talking about this, there's a lot of these games that are winner takes all kind of game. And I don't know if that's part of the race behind AI, but it seems to be, to some extent, that there might be a winner take all. When you are a winner take all, the first one who gets there has a huge advantage, right? And so building all the infrastructure for a winner take all means everybody else loses. And so will that, how that will play out in terms of somebody threw the word bubble or not, how that plays out in terms of coordination and incentives for guys to actually coordinate in terms of renewable energy when actually you have a winner take all game plan and so on. So I think all of these things are
I didn't prepare for this question, but and I don't want to pick on you, Ellen, but I know Fidelity made a big investment in CoreWeave. Can you talk about that? And how you got
Probably
how,
not.
how
But I can say that obviously we believe in the investment thesis. I think, to answer your question about how I'm a real estate person, so I'm not on that side of the team that's investing in CoreWeave, but how we're getting our head around it is a lot of these customers are paying their rent up front, 3-year lease, everything's paid up front, and you can get your head around that. But I think in terms of the long term, we're just believing in the use case and the fact that our whole world is going there, and there will be winners and losers, but I think there's plenty of room for a lot of winners.
So when you say they pay the rent up front, a year up front, 2 years up front? 3, is that
It's to be negotiated.
Wow, that's interesting.
Maybe just to begin, I think that in a perfect world, it would be a winner takes all, but we're not. And so I think that with the deglobalization that we've been seeing, I think there will be multiple winners. And so from that point of view, there is the nuance, I think, to be made.
Exactly.
That's very important. So the geopolitics is actually going to have a huge effect on being a bulwark against the winner takes all philosophy. Is it
Correct.
All right. Does anybody in the audience have any questions? Oh, we have questions. Okay, go ahead.
So it's interesting the comments about commoditization, obsolescence. There are many data center campuses that have gone from strength to strength over the last 25 years. And there are others that have gone by the wayside, right? And people are fat loss, pretty much all evaporated. And everyone seems to talk about land, power, permanence. No one talks about connectivity, no one talks about latency.
Yeah.
Most funds build data centers that pay very, very little scan regard for connectivity. No internet exchanges, I guess, operating in any of your data centers. No subsea cable SLTs in any of your data centers. So, a couple of questions there. How much of the workloads, for example, that you're seeing will be latency sensitive and real-time in nature, and therefore securely incompatible with the data centers being built later on the planet?
I would disagree. Because it's location. Yeah.
Exactly. And so colocation, what was being done in colocation 25 years resembles nothing of the colocation that's being talked about today, because you don't have the connectivity. And that ecosystem is at the heart of colocation as telehouse interaction, telecity, etc.
Shall I go first? So, prior to Google, I worked at Equinix, so I can probably answer this. It comes back to the different workloads, different solutions, right? So a large language model doesn't necessarily need the the low latency connections that you're referring to. When we get into the kind of inference world, there will be a latency aspect around that, but it won't only be latency, it'll be geo, it'll be sovereign, there'll be lots of other aspects that kind of influence that.
So what happens, does it move? That workload? Does it go from that low latency?
Absolutely, yeah.
So
Yes,
then-
because you're serving, the inference is serving a particular customer, so it depends on where that
so
customer
what's going
is.
to backfill that load?
So the load is still there, you've still got the
Because if
large
that
language
load
model.
moves out, you've got.
But it'd just be another learning model that will go into the same.
It's just a layer
So
on
the-
top, so
so
you've
it's-
still got, you've got your cloud, you'll have inference that will interact with cloud, but you're taking a slice of the data from your large language model to do the inference analysis. So there will be some latency aspect. Does it need to be right next to an internet exchange? No. But we will need subsea cable connectivity to connect all these disparate locations. Yeah.
Okay. One more question?
We're over time.
I'm sorry.
Sorry.
All right.
I just want to say one thing about you're saying, you know, about obsolescence of data centers. I mean, there's global switch data centers in London here that are still running at PUEs of 2.6 or whatever. And because of the migration risks and the you know, data loss risk, etc., like the enterprise customers have still not moved out of those, right? You know.
Because they're across the road from cloud houses.
But this is it. This is the point. No, but it's a good point. But it's a good point you made. You know. So I'm just kind of saying, don't worry too much about obsolescence.
All right, well, thank you. So we ran out of time.